Alexandra Ehrlich. I would love to introduce you to my audience at the Mortgage Consulting Group. And I've been really watching you from afar for years and years, and just admiring how well you put together deals and helping clients. And welcome to the podcast.
Appreciate it. Thank you so much for having me.
You're welcome. Tell the audience a little bit about yourself.
Absolutely. So I actually cut my teeth in the mortgage world back starting in '96. I'm not going to date myself completely, although it's much safer than dating others, especially in today's day and age. So when I started in subprime mortgage, I truly worked in that subprime environment where we were charging 8 points a deal. I was doing everything as a stepping stone or a rehabilitation as far as the sales pitch. We called them Band-Aid loans, 2-year ARMs with 3-year prepays. And I found that 90% of all people have some kind of a credit question, whatever that may be, whether it's how do I get my credit to a better situation or how do I navigate this life event?
Right.
And very often they don't put that actual label on credit itself. They're navigating life. And I found myself navigating life. So I got into the mortgage world before I ever turned 18.
Okay.
And ended up with a ton of credit cards. And nobody, please do this. However, I will simply say that I was not legally obligated to pay them because I couldn't enter into a legally binding contract.
Right.
So I had to figure out how to fix that, how to get through it.
Right.
Then I went into banking, was a branch manager for a couple banks, found myself in the corporate world and realized I'm not a corporate style person.
Right.
I'm a little too out and loud and brash, and it wasn't a great fit.
Right.
And then I ended up having kids. When my daughter was little, was doing a lot of fix and flips, doing model leasebacks with builders.
Wow.
And '08 happened.
Oh, yeah.
And found that I had no clue what to do with my life other than filing bankruptcy.
Wow.
I had to file bankruptcy, had to walk away from 8 properties in foreclosure. And it was the only way to actually sustain my family, my life, and make sure that everything else in my world, caring for my kids, could stay the priority it needed to be.
Right.
Had to rebuild from that.
Yeah.
And in hindsight, like so many ways that I could have structured things better, truly.
Oh, yeah.
Like,
It's always 2020.
yes,
Right? Yeah.
especially those most painful ones. It's like, oh, if I would have worn a helmet. Oh,
Yeah.
if I would have listened to my mother. Shh, don't admit that one. Those things in hindsight, yes.
Yeah.
And then I had my son.
Sure.
My son is phenomenal, but he was born deaf and had to have cochlear implants.
Okay.
Well, guess what? I know you have 2 kiddos of your own.
Right.
Insurance told me that hearing was not medically necessary. So you can just imagine some of the choice vocabulary and expletives that may have came out of my mouth.
I couldn't imagine.
Yeah.
Wow.
So I just signed every single consent that the doctors put in front of me. I'm like, yep, if I need to file bankruptcy again, oh well, so be it. I'll do it. I'll survive. Like, we got to get the
Just
kid.
get through it.
Yeah.
Yeah.
Got my kiddo cochlear implants. He's 100% mainstream, has never had any accommodation.
Okay.
Couldn't be more proud.
Wow.
And in that process, ran up over $180,000 in medical debt.
Okay.
That then, get what happens, and you see this every day.
Right.
It got sold, resold, sold again, sold another time.
Yep.
According to my credit report, I owed over $500,000.
Wow.
Fought 4 rounds of appeals,
Yeah.
a little over a year.
Sure.
Finally won. Ended up having to stand in front of a room of board-certified doctors and plead my son's case as to why this was medically necessary, why this was the right approach.
Right.
My final bill was $21,000.
Wow.
Here's the kicker. And this is probably something that you see on a regular basis.
Yeah.
And the thing that I hope people don't have to experience the pain of.
Right.
By then, my credit score had gone from mid-700s to a 502
Of course. Yeah.
because of all these medical collections.
Right.
I had to humble myself at, we'll just say, over 30 years of age.
Right.
And I couldn't use the equity in my house. Couldn't raise a credit card limit.
Yeah.
Had no savings.
Right.
Had to go to mommy and daddy and go, can I put $21,000 on your credit card, please?
Right. Right.
and can I try to figure out when I'll pay you back?
Yeah. Right.
And gratefully, they were willing to do that for me.
Sure.
Was able to go ahead and rebuild.
Yeah.
And then pretty much not too far after rebuilding,
Right.
went through a nasty divorce.
Sure.
luckily had a lot more knowledge at that point to kind of navigate from a place of intentionality instead of reactivity.
Right.
The things in divorce court that you can't even imagine that judges and attorneys put into place without thinking about the contracts at play are mind-blowing.
Right.
Again, stuff you see every day, right? On the mortgage end, here's my divorce decree.
Right.
He's supposed to pay the bill. She's supposed to pay the bill.
Yeah.
He's supposed to refinance the car. I don't actually pay that. Oh, but it's coming out of our joint account.
Right.
Well, we got to count it.
Right.
So navigated that and created my business. And here I am over a dozen years later.
Yeah.
And I've realized that if we look at credit from a strategic standpoint, if we look at it not just from building or rebuilding, but truly from a how do we assess every ounce of risk, and more importantly, every ounce of opportunity.
Right.
I'm not going to ever say that credit and debt are equal. And I will say that having access to debt and debt leverage would have saved me so many times over, and now has saved me like just so much pain.
Yeah, and the fact that you meet people where they're at right now and what they're going through is huge, because for me as a mortgage broker, the way I align best with you is that you're able to really get into it down the deep rabbit hole of what somebody could be dealing with of a specific item. Sometimes so good, I don't even know what you do. Because I'm like, just talk to Alexandra. I'm like, I have the person, just call her. I don't know what she does, but it has to do with your credit, and it has to do with we close loans, right? Because we do deals. That's the main handoff to you, and I trust you, and I've seen you adjacently in the credit field and what you've been able to accomplish for my clients. And that's why I want you on the podcast, because this is where we actually close deals, is with people that have gone through it. I have gone through 2008. I went through the ups of 2005 and the downs, and we saw rates jump up in 22, and that was another big attrition event in the mortgage industry. So the focus is how do we meet the customer face to face, and when they could be going through the same kind of rejection of, what is this collection on my credit report? That's a big one, is collections. And not only collections, but medical collections, because one of the biggest culprits of ruining somebody's credit is them going to the hospital and then the bill getting sent to the wrong location, or how quick doctors' offices are.
Not realizing copays. You guys, this is a huge one. How many times have you gone in for a procedure? You think that you have a copay of, let's just call it $20. However, you actually have 8 copays of $20. You have one for the anesthesiologist, one for the facility, one for the surgeon, one for the surgeon's office, one for the admin, one for the nursing care prior to the surgery, one for the nursing care after. So the $160 isn't a make or break. However, 8 bills from 8 people that you didn't know to expect. So therefore you either don't get paper mail anymore and you don't open it. Or you open it, you pay the one at the $20, which you were anticipating, and the other 7 now go by the wayside.
Yeah, and then they show up on your credit because it didn't go to your mail for some reason. You didn't get it in the mail. But when you apply for a mortgage loan with me, all of a sudden, I'm asking you about these collections, and you have no idea who the collection is because it's been sold 5 times since the doctor's office or anesthesiologist sent it off to collections, right? So this information is very vital for people to know, and especially when you're navigating the mortgage industry, you're navigating buying a home and financing that purchase, right? And one of the biggest purchases that people make in their life is buying a home and financing, and you don't want to go in blind. You want to know where you're at. You want to work with a broker that can help position you with the right people and that you can trust, that will meet you where you're at, go over the credit, help explain it to you so you know what you're dealing with, and then come up with a solution.
But you just said it right there, though. Like, that's why you're a broker, is because you have this tool belt. And every single one of the companies that you have access to, all of these amazing professionals that you have access to, that's your tool belt. And so you're like a master craftsman.
I like the bat belt. What's it called? The Batman, the tool belt that Batman has, the utility belt. a Batman utility belt.
Okay, you know where my brain went with that?
What?
Inspector Gadget.
Yeah,
No, I don't go
I love
Batman. I go Inspector Gadget.
Inspector Gadget.
Go Gadget Mortgage. Yes.
Yes. So, Go Gadget Mortgage. No, coming to a podcast near. No, the tool belt that we have as loan originators and that align ourselves with a lot of different banks.
But let's also be clear.
Yeah.
Is you're saying as originators.
Yeah.
And I don't think that that's necessarily accurate. Like you specifically have gone above and beyond to build out your tool belt.
That's true.
And whether it's Batman or Inspector Gadget or just, Builder Bob or Toolman Taylor.
Yeah.
Like any which way you put it, you truly have gone above and beyond to know your craft and to build this out in a way that not many people in your industry have ever done.
Right. Yeah, and I credit 22 to that. I credit having to grow. Like my main source of business was referrals from bankers, right? And then when bankers and a lot of banks started expanding their products, I wanted to expand my product pool even bigger, right? And I wanted to know everything in the market. So that's why I've aligned myself with a commercial source that I have access to. I think some numbers were 7,000 different commercial lenders. I think the most recent number we looked at was we had about 5,000 different sources we could go to for the on the commercial side. Now on the residential side, I have Mac 5 Mortgage, which is my sponsor here locally, a local boutique mortgage shop, and we have about 50 lenders. And then my second sponsor is Loan Factory, and they have about 250 different loan choices, wholesale investors. And then on top of that, I have a good network of private money lenders, hard equity lenders, and I mean, the box just keeps expanding, right? And but the one thing that stays true on any customer that comes to me is what's the credit score? Yeah. And how do we get the credit score that's going to qualify them for the product? Generally, we want a 700 credit score in the mortgage industry. And I come to you and
let's talk about that for a second though, too, is do you want a 700 credit score that they see online?
Right.
Or do you have specific bank scoring models that you have to use?
It varies.
Yeah.
It varies lender to lender, product to product. And I have a digital HELOC that is just Experian.
But which version of Experian? So real quick, that's one of the things that I get to dork out on every day. And that for me is my fun puzzle is which scoring model are we working with? There's actually over 80 algorithms in existence as far as scoring models. And each one is different based on either risk or different tools of assessment that any different creditor or vendor even wants to look at. So an insurance credit score is going to be radically different than a credit card credit score could be because of the algorithm that they apply to the data.
Right.
Now, here's what's cool. The data for each of the three bureaus is always going to be consistent across the board. Right. So everything with Experian that's housed at Experian is always going to be the same data, whether you look at it, the local bank looks at it, or even the insurance company looks at it for the car.
Right.
However, the scoring model that gets applied to it and the numeric calculation that gets spit out could be over 100 points different.
Wow.
On that same data.
That's massive.
So when we know that and we know how to play with that box, that's when it gets really cool.
Yeah.
Now, consumer scores, why do they have their own consumer scores? Whether it's on their credit card or Credit Karma, freecreditreport.com, why do we see a major difference? The major reason we see a difference in those scoring models is because of the back end.
Right.
If something ever doesn't make sense, follow the dollars.
Right, yeah.
And so those dollars say, how do we get paid? We get paid by banner ads, we get paid by click-throughs, we get paid by affiliates. Well, I, as a consumer, am not going to click on this 0% credit card if it says minimum credit score of a 680.
Right.
And I have a 580. So instead, they use the model that's most advantageous without telling me which one is required for the product so that I click through and they get paid.
Wow. Wow. So that's like a little cheat that they do just to get that extra click to get paid on that click. Wow. So with the mortgage side, I don't dive as deep into all of the scoring models, but I do have a little bit of knowledge in a way that we use Advantage Credit a lot of the times. There's a new Vantage score. There's the Beacon 8 that we use through Experian and the general FICO score. Now, tell me more about what I'm using. Like when I pull credit, when I pull a 3 bureau through Advantage Credit and I send it over to you, and oftentimes I'm like, hey, we need a rescore. I need this to go away. And you're like, I'll go to work on it. I'm like, I don't know how it does. I don't have the bandwidth for it. You figure it out. But you get it done and you get the score up. Tell me, like, you don't have to take me into the kitchen to show me how you cook it, but bring me into the living room a little bit.
Okay.
Let me know.
So first off, the scoring models that you're actually using are 542,
Okay.
FICO 542.
Okay.
And the most recent update out of any of those was back in 2004.
Right.
So we're using a 21-year-old model.
Okay.
Now, there's been a lot of talk in the mortgage world specifically about the fact that we're now using Vantage and we now have access to this new FICO.
Yes.
Well, guess what? The Vantage that we're using is Vantage 4.
Okay.
Vantage 4 was designed over 10 years ago. And what it uses is it uses trended data that has always existed.
Okay.
And there's actually some really cool articles from about 10 years ago that talk about how are people consumers, so they're constantly spending, or are they savers?
Right.
So they're paying down, paying off their balances every single month methodically.
Yeah.
And should this count towards how someone's credit risk is actually analyzed, assessed, and utilized from a underwriting perspective?
Sure.
So as far as what we can do and look at when we're looking at that report is what goes into it.
Right.
I know you don't want me to go full blown into credit scoring.
Sure.
So I'll just keep it short and sweet and say, when we're looking at the report, we have to decide how do we get the most bang for the least buck?
Right.
And really
Exactly.
move that needle.
Yes.
And as you mentioned also, like, it's really cool because everything we look at from a financial standpoint is impacted by credit.
Okay.
And the average consumer, for every 20 points below a 740 that has 2 cars, 2 credit cards, and a mortgage, spends an extra $5,000 per year for that 20 points.
Oh, wow.
So if our average consumer is at a 680, that's 15 grand or more that they're spending
Yeah.
just because of that score.
Wow.
And here's the kicker. That can happen, that 680 could happen with nothing ever being late.
Okay.
That could be with not one derogatory item on the credit report.
Wow.
Simply by being maxed out on all revolving accounts. And here's where we can really get in and do fun things. I look at it and go, what is giving us our biggest hindrance on score?
Yeah.
And is score our objective? Or is underwriting our objective?
Sure.
And if it's score, do we pay everything down? Do we pull a HELOC at a crummy rate as step one?
Right.
Pay off everything that's revolving. Now, what's revolving? Real quick, just to kind of inform everyone.
Yeah.
Revolving is credit cards, store cards, personal lines of credit, oftentimes now overdraft lines of credit report,
Okay.
and many HELOCs report as revolving. And so we want to just be cognizant, is the HELOC reporting as a mortgage? Ideally, that's what we want. We want it to report as a mortgage, not as a revolving account.
Right.
We take all the revolving things where, here's what's interesting. It doesn't matter if it's a $300 gas card, $300,000 Amex.
Yeah.
If it is coded as revolving, the only thing that matters is the balance versus the limit.
Yeah.
It doesn't matter the actual dollar balance.
So let me interrupt you here. Amex.
Yeah.
Amex.
Yes.
Amex. Always maxed out.
Okay.
They always show up maxed out. There's no line of credit available usually that I see.
Only on their corporate and open accounts.
Okay.
So they have 2 different totally types of accounts. Next time you're looking at this on a credit report, do me a favor, look and see if it's open or revolving as far as the coding for the account.
Okay. Maybe I'm seeing open.
Yeah.
Okay.
So open is a due in full monthly.
Right.
Amex actually got this excluded from the scoring equation, created a full separate category called other.
Okay.
Back in, I want to say this was right around 2008.
Okay.
I hate to name names, but Capital One was the biggest loser in this class action lawsuit.
Okay.
That all these people went to that and said, wait, Mr. Courts, Mr. whatever it was, all of my limits every month changed to match my balance.
Right.
This was happening pre-08.
Right.
Credit card companies every month, if my balance was $1,522, my limit was $1,522.
Right.
Why did they do this? They did this because it reduced my score, sent me into default interest rates.
Right.
So now instead of them charging me 14%, they charged me 29%.
Wow.
Well, this became a big federal thing, and they said, no, you can't do that. You have to report the actual credit limit.
Okay.
Amex got in and said, wait, our clients don't have credit limits. They have an open account.
It's any of them.
And they can just use it.
Yeah.
They don't have a preset spending limit
Okay.
on the majority of our products.
Okay.
So that's where that open and other category got developed and devised
Sure.
by that industry.
And are you able to, specifically jumping in on that, right, holding on to that, switch an open account? It's listed as open account on the credit report, but is there a way to change that to show it as a revolving account to benefit, or you don't want that?
You don't want it to.
Okay, because that would just...
You can max out that open,
Okay.
and it will not impact the 30% of your entire score.
Okay.
That is that balance versus limit utilization.
Got it. So we don't need to worry. We move on to the next
Correct.
trade line on the account. Okay.
And what's really fun, though, is we can manipulate this category a dozen different ways.
Okay.
We can add trade lines that now dilute that ratio.
Got it.
We can raise limits to dilute that ratio.
Right.
We can strategically do so many things.
Yeah.
We can balance transfer onto one card to dilute the ratio on everything else.
Wow.
We can pull a HELOC to pay it off, or a signature loan, or even an auto loan, anything to get it out of that revolving category.
Right.
30% of your score. Let's think about that. So if I'm at a 620 with nothing late and I'm just maxed out, let's call it on $20,000 of credit card debt.
Right.
Simply by paying that $20K off, my score is going to shoot up over 740.
Wow. You really are a strategy queen, I would say. The way you strategically go into credit, look at everything, analyze it, is extremely impressive. I don't know anybody else in your field that does what you do.
I don't think there is.
Yeah.
I don't think there is.
So hats off to you and kudos to you for that.
Thank you.
Tell me, so the big success story that we had last year was a client. I'll just call him Casey. Joe works. So Joe was a past client, which qualifies him for my VIP client treatment, and which means that he gets that extra service, that extra boutique feel and credit on some cost, with conditions. Now, I get him over to you, and I'm in a situation where I need a problem solved. Joe has a credit score in the 600s, and we're working to exit out of a bridge loan. All of my other
Real
solutions...
quick, what's a bridge loan? I don't know that everyone knows what a bridge loan is.
So, good question. So there's different types of bridge loans. There's bridge loans that can help you sell a property or help you buy the next property. The money can be used for whatever you want it to be used for, but it's a temporary loan, usually about 1 to 6 months, short-term financing. If you do a standard mortgage, the lender expects you to hold it for at least a year. But and there's a cost to the lender if you pay it off early. But bridge loans don't have that cost because they already assume you're going to pay it off quickly, like under 6 months or so. Or sometimes they could stretch to as long as 12 months or 24 months. In this specific situation, it was a private individual lending his own money for a corporation that I work with. And we had done a loan that was a short-term bridge loan that had extended out. They had to keep renewing it year after year. And we're trying to get it off the books of this specific lender that I work with. And we generally will go in and we'll build out the exit strategy for the client in the very beginning, but things had shifted enough for this client to where that was no longer viable. I had brought it over to you as I need a 700 or better credit score in order to double the amount this person qualifies for. Tell me how we get this done. He's ready to go through the consulting process, help jump through all the hoops, cross all the T's, dot all the I's that you need him to. What can we do? And
Yeah. we reviewed the report and it was, okay, all we need to do is tackle these couple specific accounts and strategically attain a letter of deletion and allow you to do what you need to on your end, which is really cool too. Like you have some of the most amazing vendors and background knowledge to navigate the rescore process. Not a lot of lenders out there
Sure.
both are willing to and actually know how to do it efficiently.
Let's dissect this, right? Because this is we're going into the weeds a little bit in the kitchen to show how things are cooked. So I take in a loan application on a client. I run credit on the client. I have a vendor that I run credit through on the client. The vendor then gives me an option to rescore the client based on specific changes to the credit report that we change permanently. So then I advise the client to go over to credit strategists like yourself. And then when they go over to you, I work hand in hand with you to strategize and to work on that rescore for that client, on what's going to benefit them, that what we change and strategically work on their credit together. How are we going to get that credit score over 700 is the ultimate goal that we're asking ourselves. And we go through that checklist and knock off those items on that list.
Yeah.
And generally giving me the ability to be able to work with somebody who can dive deep into it, also using a vendor that allows me to do a rescore on a client. They come to me with a 640 credit score and they leave with a 740 ideally. And they come to me requesting a loan for say 500,000 and then they walk out getting a loan for $1 million, right? Because we've adjusted enough on the loan qualifications and guidelines side to allow them to maximize their qualification numbers. And we've gone in through the weeds. We've worked on the credit. I've worked on the income. I've worked on the down payment and come up with a strategy on my end, right, to just get that final piece on your end to knock out. So,
well, and like on Joe, perfect example, Joe actually had both sides. He had a score constraint and an underwriting constraint because of the specific types of derogatory information on the report.
Yeah.
And he had already beat his head against the wall, calling these companies, going, come on, please, anything, you guys.
Yeah.
You can see I've been great all this time. This was a total fluke. And that's the other thing. More often than not, the things that we deal with when it comes to our credit have 100% justifiable, understandable reason or are truly an error.
Right.
Like that medical bill. Let's go back to those copays. That's not malicious intent. That is not a lack of responsibility financially.
Yeah.
That is a fluke. That is the fault. If we want to be really real, and maybe this is a little bit of a high horse for me, but it's the fault of the medical professionals not notifying you.
Correct.
And not calling and not just being good old human beings and communicating.
Right.
So same thing kind of happened with Joe, where he had a completely explainable, not his fault, therefore inaccurate reporting. We were able to get those letters and you were able to turn that around through the rescore. Now, the main thing to also clarify is what's that rescore process.
Right.
Through your credit vendor, we're able to walk in the back door, go knock, 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 credit bureaus, and say, hey, we're here for brunch. Can we go ahead and all sit down and enjoy a good meal? Instead of me having to go through, send certified mail, the client going through, spending hours on hold and hoping, crossing their fingers, something happens.
Right. Yeah. I would like to say there's 3 guarantees in life: death, taxes, and medical collections. It's the most egregious thing is the amount of medical collections, and anytime that I'm trying to get a loan across the finish line, and it might be a government type loan, one of the biggest things that we look to allow through the door for approval is we understand life happens. We understand all of these things that involve health. We're human beings at the end of the day, are extenuating circumstances beyond our control, right? People go through these things in life and it's okay. And oftentimes I'm there as the first line of defense to say, I understand. I understand the medical stuff was reported on you. I understand it so much so that I'm going to help you with this, and we're going to write a really strong letter of explanation for underwriting. We're going to maximize your credit score as much as we can now to get you that loan. So that's the main focus on my perspective is there could be a lot of accountability on the medical professionals on how they treat billing consumers, which I think is probably not as bad as it used to be. It's gotten better. but it's been
But we as a society have also messed that up. And
Right.
and like quick little tips, tricks, never, ever, ever sign up for e-statements or e-billing until you've received at least 2 and you've confirmed your email address.
okay.
Because how many things go to spam?
Sure.
How many things, like if you don't know to expect it, you don't know to check your folders and your files for it.
Right.
I mean, let's be real. It's not just the medical. I'll give you a perfect example for myself.
Right.
Guess what I got in the mail the other day? I got a bill from Saks Fifth Avenue. I had bought my daughter a really cute dress.
Sure.
And I haven't used my Saks Fifth Avenue credit card in probably a year.
Yeah.
So cool. I still get paper statements.
Yep.
I prefer paper statements.
Yep.
I get this statement in the mail and I'm like, wait, I don't need to open this because I just paid you guys off in full. I was on the phone. I paid it. I said, I want to pay the full balance.
Right.
I'm like, no, I'm going to go ahead and open this.
Yeah.
Like there's something just,
Doesn't.
it's bothering. I'm like,
Yeah.
okay, open this thing. It's a bill for $2 for a minimum interest charge. There shouldn't have been an interest due,
Yeah.
but for actually taking my payment by phone and using the card, there was a minimum interest charge that got charged in arrears.
Wow.
So the following month, after I thought I had a zero balance,
Yeah.
and I'm like, thank goodness I opened that.
Right.
The number of people I see having problems because of an annual fee on a card that they don't even think they still own,
Right.
or a $2 paper statement or $2 minimum interest charge
Yep.
is mind-blowing to me.
Wow. Enough. We're beating up the medical professionals enough. And by the way, I do have a doctor's loan.
And the
so
credit card professionals.
if you do need a mortgage, we have those. The best way for us to help our clients together, and as we proceed into the future and try to come
Woohoo,
up
we
with,
get to go into the future?
yes,
Let's go into the future.
let's focus down over the next year. Let's not go too far into the future. We want to take it one bite at a time, right? So and people ask me, what are rates going to do? I don't try to predict that. I don't have my crystal ball, but I'm going to put on a crystal ball hat,
I think we should do
Or-
the Magic 8 Ball.
the magic 8 ball. Okay.
Yes, I actually watched I don't remember what the TV show was. It is like a medical drama.
Sure.
And this lady deferred to all of her decisions to the Magic 8 Ball.
Right.
She had like won the lottery and was like, I don't trust human objectivity anymore.
Okay. Yeah.
She's like, there is no human objectivity in the Magic 8 Ball.
Yeah.
So she's like, I'm totally good with whatever outcome it tells me to do. And she had named it like George.
Right. Well, we're going to have more control over our future than the magic 8 ball. So I think moving forward, how we best work together would be, as far as credit goes, bringing people to you, having you work on their credit before they're out looking at homes, number one, right? Because if they're going under contract, they haven't updated their lender letter in 3 months, their credit maybe kind of went by the wayside. Generally, now you can correct me if you recommend me to work differently, right? I'm always trying to improve. I always want to learn more. There's always so much information coming in on the credit arena. I just don't have time to stay on top of it. So normally what I do is I say, download Credit Karma and download the Experian app. Keep an eye on your credit. Don't lock the credit report. Monitor it, right? Monitor changes, but ignore all the ads. Go through the free versions. Don't pay for it. Don't do the hand holding. If you can avoid going to a credit service that just holds your hand and charges you $100 a month, because it's a waste of money, in my opinion, if you don't need that. Now, there's people that might need that, but I'm talking about you and I working together in the future. Would you advise anything different other than what I normally recommend?
A little bit.
Okay.
And not because anything you're advising is not really great, solid information.
Right.
It's the potential misinterpretation.
Yep.
We live in this very information-driven society. We have all of this stuff on our phones, on our watches, on our laptops.
Right.
And when we talk about that free version, I'm going to go ahead and pick on the 2 companies you just named.
Sure.
Both Credit Karma and Experian.
Yeah.
If you do not log in every day, try what happens. Try this yourself. You will immediately get alerts.
Yeah.
And why? Because they need to sell you.
Yeah.
Those free versions, they have to buy your credit report.
Right.
Just because Experian is a data clearinghouse does not mean that they don't charge themselves for the actual report, for the customer service reps, for the web hosting, for all of these things.
Yeah.
So how do they make that money? The only way to make the money is affiliate payment.
Right.
Or by charging you.
Yeah.
So what happens when you log in and you click F? By the way, if you're looking to improve your score, a new card might help you. They're not totally wrong. It might help 20% of all Americans.
Right.
But it also might not for their specific scenario.
Correct.
And it might be the wrong step in the wrong order for them personally.
Yeah.
That's the challenge. And the challenge also with the traditional credit repair companies out there isn't just the fact that it's $99 a month indefinitely. It's when we talk about what is support and financial literacy.
Right.
They're not truly serving that bigger goal. They're not really hand-holding through the process.
Right.
They're sending a bunch of letters.
Yeah.
Now, the biggest challenge with that is if the same consumer that's in there for an average of 18 months,
Right.
save that $100 a month, that's $1,800.
Yeah.
That average consumer, if they applied that $1,800 towards their debt or towards opening a secured card or towards bringing all their accounts current, would actually have a higher score than they will get with 18 months of traditional repair.
Wow. Yeah. I mean, that's clear as day, right? And when somebody does go forward with saving that money, putting it aside to deploy that capital at the right time and work with you, what's the best way for me or another mortgage broker to align them with you and the process and working with you and to best refer you into that relationship through that life cycle of that customer looking to buy a home?
Yeah.
Use that $1,800 towards increasing their credit score. Maybe they're looking to buy in a year or 2 years or 5 years, but they want that goal in the future of home ownership, right? They're renters now. They just want to get out of paying the landlord's mortgage.
Yeah.
Yeah.
So first thing is we always want to tell everyone, if you're monitoring, great. Monitor for the actual result of what you're doing. Don't monitor just to monitor and to add a full-time job. I oftentimes tell people, turn it all off. Like, get out of it completely because all it's doing is stressing you out and you're not seeing the long-term picture.
Right.
Why do scores change on a daily basis? Because different creditors report on different days.
Yep.
And they don't report on the 1st of the month or the 15th or the 30th. They report on the statement closing dates.
Right.
So we could see massive fluctuation on a daily basis. Okay. That being said, joint email introduction, let me review the report first, even give you an assessment of what I'm able to do and say, this is a great fit, send it over. No, this is going to be a problem.
Yep.
I can't really help.
Right.
And the nice thing is I come from a standpoint that everything comes full circle.
Right.
And I'm pretty unique in that, just like you are, where you're like, if we don't work together today, that's fine. We'll work together 5 years from now. That's totally cool.
Right.
Looking at it from that perspective is let's assess the report. Let's assess your reality. And let's assess your goals.
Right.
They may think that their goal is to buy 5 years from now. You and I might look at it together and go, guess what? They can actually buy today.
Right.
And it may not be the most favorable terms, but what they gain from a credit perspective, a equity perspective, everything far outweighs waiting.
Right.
So let's get into this and then spend the next year perfecting it.
Right.
We don't have to start up here.
Yeah.
Like, I wish everyone could learn from every one of my mistakes.
Right.
And also, like, the tools exist to do things proactively. Perfect example, our kids. And, you've got 2, I've got 2. My daughter's 19.
Yeah.
The minute she turned 18, actually 2 days later, because it was a weekend,
right.
We go in, get her first credit card.
Nice.
Her first credit card, I didn't co-sign on it. She had an 802 score.
Wow.
When she applied for it, got a great limit, great card, not secured, no annual fees, getting all of the cash back. She's getting 5% cash back on every purchase.
Yeah.
Like,
that's amazing.
That's the way to start and to build. And then she's just, has taken it to the next level. Yeah. She pays this thing off every week.
Right.
I'm like, you don't need to do that. Like, I love that you don't have debt. Cool.
Right. Yeah.
But you don't need to be quite this much on it.
Right. Where I see that benefiting clients is going back to the increasing that credit score now to buy right now.
Yeah.
The time of the market, right? Timing in prices now are going to be much better than if we see a big rate drop and prices shoot up next year, right? So getting into real estate now, you have to live somewhere. You might as well focus on where are you at right now, and is it the right time for you to buy? Because when I talk to, or when a customer will talk to a realtor or a lender or somebody with a lot of pressure to pressure them into buy now, they'll say, now's the best time. Well, it's not always the best time. You have to assess that where you're at and meet yourself realistically. Is it the best time for you? Because if you're going to be buying a home now and then your company's going to move you out of Colorado next year or in 2 years from now,
break even?
You're going to lose money.
Yeah.
Yeah.
I love that.
You really want to lose that money? You know, well, that's where a strategist comes in, right? That's where we strategize and we know, is this going to cost you money, or are you going to probably see some appreciation? Hopefully, ideally, we see more appreciation. That's the goal.
But that's also really cool too, though. It's like when we think about, I know it's a little cliche, but there's the 5 Ds of real estate.
Right.
Okay, you're familiar?
The 5 Ds.
The 5 Ds of real estate.
No, tell me.
Okay, and because they apply to mortgage and they apply to credit.
Sure.
Is diapers, diploma,
yeah,
diamond, divorce, and death.
Okay.
Okay, so all
So the 4
5
Ds. So you're telling me about the 4 Ds, right?
Because we're never getting divorced. Got it.
I wiggle it, but it's not coming off.
So those same events, those same mile markers, not only that cause us to move, but also should be part of that end game.
Yeah.
If we're right now at my daughter's stage of diploma,
right,
and about to have college diploma,
yeah,
great. She's got all of these things ahead of her. She should be thinking, what's that next step? Is that she's been with her boyfriend 2.5 years.
Right.
That next step very reasonably could be a diamond.
Right.
So if she bought a house now, what would that look like 3 years from now when they actually get married?
Right.
Would she still want to keep the property? Would it become an investment property?
Mm-hmm.
If we start with that end in mind, knowing that these next milestones are going to happen,
right,
how amazingly leveraged can we be?
Yeah.
Same thing with credit.
Right.
If we know that we're graduating, we should know that if we've taken out student loans, at some point we're going to have to pay them. It's a contractual obligation.
No.
Yeah, who would have thought?
I don't want to pay my student loans.
Because the same way you think about medical is how I look at and the industry looks at student loans.
Yeah.
That's the other one that I see go haywire all the time. And it's not even because of people going late or them coming out of deferral.
Okay.
Or think about all the addresses and email addresses you have over the course of school, all the way through to graduation to like coming out of deferral.
It's tough. They don't know where to start,
Correct.
Right? Students.
And here's the other thing, that Credit Karma and Experian and all of that.
Yeah.
Oftentimes they're like, consolidate your student loans. Well, if we think about our credit score as a chessboard,
right,
if we move something, what else might move where?
Yeah.
Okay.
Right.
So if I take 15 student loans and I consolidate them into one,
right,
they're all 10 years old.
You're playing checkers.
They're all 10 years old.
Yeah.
And then they move to 1 month old.
Yeah.
What else did I manipulate on this table?
You removed number of trade lines.
And
the total line of credit available.
No, because they're not revolving.
Okay. So
average length of history.
Length of history, yes.
I annihilated my length of history.
Yeah.
Because again, let's just say
you're a baby.
I'm only
You're starting
25,
brand. Yeah.
And I just took my 8-year-old accounts and made them 1 month old.
Yeah.
I could have dropped my score 60 points.
You just went back in time 8 years.
Yes.
Jeez.
I want
Don't
to really
be time
do that. Can we do that here? Let's do that here.
Don't time travel when it comes to credit, but time travel when it comes to looks and age. And I want to go back and erase all my wrinkles, right?
But wait, I think you just gave me one of my new taglines.
Yes.
We can Botox your credit. We can put it in a position so well positioned that it's frozen at the perfection.
We'll just freeze it.
Yes.
Freeze it. Don't freeze it, but Botox it.
I'm your credit Botox.
Credit Botox that. So the child may be getting married, or the worker, the employee that may get shifted outside of the state. You know, all of these things are very different strategies that we have to look at and structures. Somebody coming into us doesn't have a clue because they've never been through this before, but hopefully we've seen enough in our 20 plus years that we can say, okay, there's a direction here. I've seen this before. I know what I'm doing. I can, there's not much we haven't seen, right? If there is, we usually have the resource to figure that out. So,
well, and that's what's also really cool about that is if we start with the end in mind, which is what I feel like you do exceptionally well.
Right.
Is this a short-term loan? Do we do a bridge?
Right.
Do you just need to get some cash to pay some bills, medical or whatever else? Great, let's do a HELOC. You have access to all these programs. We can always start with the end in mind.
Yes.
And by doing that and saying, it's not just the end goal, it's the end exit strategy.
Right.
Because whether we're exiting life, inevitably, you said,
yes.
What are the things that are unavoidable?
Yeah.
Whether we're exiting life or we're exiting our career or exiting even having a job, that's called getting, to a point of retirement.
Right.
Like all of these different stages, if we start with what does that piece look like and the timing of it, so many more pathways now just got created.
Right. You're on TikTok, right? I'm not. I mean, I am, and then I delete it.
I am not intentionally on it. My daughter and son both send me videos.
Sure.
We have a bulldog, so they send me bulldog videos. It's just kind of our thing.
Yeah, see, I'm an 80s baby, so, TikTok, I'm good with Facebook. I was on MySpace, but TikTok just, I don't know. But what I hear from what you've told me kind of in passing is that there's some, I guess, gimmicky and oftentimes misleading ads that people are throwing up on TikTok. So for those TikTokers out there, what's the reality check that they should see now? Like if you're going through TikTok and you're great, and then you see something on credit advice, what should they really see? Like, what should they really, within like 5 seconds or 10 seconds, what's the right thing? What's the right message that TikTok should be telling people and the younger generation about credit?
I think you just said it right there.
Yeah.
Is it can't tell a right message in 5 to 10 seconds.
Yeah.
My initial consultation with anybody, and this is after I've had the report, I've already assessed it, and then I'm talking to them about their goals and applying the two together, starts at 15 minutes.
Right.
And quite frankly, most of those 15-minute calls run to about 45.
Right.
There is just no way to tune into your personal scenario and really factor it accurately, efficiently. So we live in a tweet society. On top of TikTok, we've got tweets. Everything's a T.
Yeah.
To a T.
Yeah.
And so what I like to say, and I've said this as a parent more times than I can count, is we don't talk in complete sentences anymore. It's not that any of the information's bad information. It's how do you take that information, apply it to yourself, and get the complete information for your complete scenario.
Right.
And the only way to do that is by engaging with someone that will give you guidance and give you advice. Correct. Whether that's your parent or which 80s babies, like, unite.
Yes, let's go.
Our parents didn't necessarily teach us finances in a way that is efficient in today's world.
Right.
Whether that's because of automations or technology or whatever else. Yeah. So therefore, the way that we approach our children and the way that they consume data, we have to come and meet them on that level. But also same thing with our generation before us that shies away from technology, that shies away from things. And they're like, yeah, my social, it might get compromised. There was a data breach. What do I do?
Right.
So I think the best advice I can say is take everything with a grain of salt.
Yeah. And
assess where the money is for the person giving the content. If it's a realtor going, yeah, get on Credit Karma.
Right.
Well, it's a realtor. They want you to buy a house.
Right.
Why should they be talking about your credit at all?
Right.
I love my realtors. I love that realtors come and learn from me, come learn from you.
Sure.
And I think that we can help facilitate them showing property and showing the difference between can lighting and a skylight.
Right.
As probably a better topic of conversation. Didn't mean to just pick on all the realtors.
No, I think TikTok is interesting because it's the short bites, right, that everybody floods to. What I'm, I guess, getting at is the next generation to buy homes, right? Mm-hmm. One thing that I'm very passionate about, I care a lot about, is home ownership amongst the younger. And I think our average home buyer age is over the age of 35, I want to say.
Oh, wow.
Well over 35.
Is that a Colorado statistic or
That's
national?
national.
Okay.
That's national. So, and I'll link to the national stats on that below on this video on YouTube. But the point I'm trying to make is that if you're just starting out and you want to build wealth and you want to do it by buying your first home and you want to hack a house, right?
Yeah.
Roommates
Totally.
in several rooms, buy a single family and have some cash flow along. You're not going to qualify for the mortgage. Maybe your parents could co-sign, but in general, building wealth through credit, through having good credit, younger age. I have a 6-year-old and a 4-year-old. You said, hey, why don't you set up a business on one of them? And then by the time they hit 16, in 10 years, I'm going to have a 10-year-old credit history on that business. And that's going to be what they use to co-sign on that property.
Yeah.
And I love that for the generation. And I love the idea of getting that out to TikTok, getting that out to Instagram, to all the socials that the younger generation is on, and letting the younger generation really lower that average first-time home buyer age. I mean, that's the goal for me, and that's really what I want to see.
Though, like, that's interesting. You immediately go to they won't have the income to qualify.
Right.
Well, wait. Yeah. If you buy that property for each of your kids today,
right?
Okay, and you have some cool products, you could do it as a DSCR or whatever else.
Right.
So you buy each kid a property today.
Yeah.
Put it into an LLC.
Yep.
Okay.
Right.
Then you take the rents every month, put them into the business bank account.
Sure.
Then you sign that business over to your kids.
Through an operating agreement.
Yeah, whatever you choose to do, or even a full sale of the business to the child. No problem.
Sure.
Whatever you want to do.
Right.
By the time they turn 18, so let's just go with the 6-year-old, that's now 12 years later.
Right.
You have 12 years of landlord experience and rental income that now qualifies as qualifying income, plus their job that they've had for 2 years at UPS, slinging boxes.
Yeah.
Cool. Between those things, they can now not only refinance this property and pull cash out to put down on their first property in their personal name, but they also have qualifying income to do it.
And they now own a rental property that they can convert later into a primary owner-occupied by refinancing.
But why would they take away all of their opportunity on their own purchase of all the first-time home buyer stuff and the grants and everything
else? Take your grants,
because
take your
this is in their
first-time home
business
buyer.
name. So they don't have a property in their personal name.
Okay.
But they do have qualifying income.
Right. And how do we handle the personal credit item?
So moms, dads, okay, couple things. This is great advice.
Yeah.
Please let me get on back on my little high horse.
Sure.
Come on, rodeo.
Yes.
Is if your children are under the age of 15, freeze their credit. Freeze their credit the second that they get a social security number.
Okay.
I don't care if that's at 1 day old. I don't care if that's at 1 month old. Freeze all 3 bureaus.
Right.
Experian, Equifax, TransUnion. Our children are at the greatest risk of identity theft of any generation out there, both today and historically ever in the past. Wow. Why? We're starting to recycle socials. We're also in this technological day and age where we're not checking our kids' credit because they don't have access to actually signing a contract until they turn 16, 17, 18 years old. Yeah. So how many years of identity theft could happen before we are ever aware of it?
Wow.
Freeze your kids' credit. Second thing is once they get to whatever age actually makes logistical sense. I'll give my kids as an example. They hate that I do this, but I will still do it anyways.
Sure.
My daughter, I added as an authorized user on credit cards when she was 14 because she was traveling internationally by herself. Okay. Not with me, but through groups and whatever else. So she needed to have a card that matched her passport in her name at 14.
Okay.
My son is 16. He still doesn't have a card in his name. I just finally ordered a card in his name, got him added as an authorized user on my card. Okay. Literally last month for his summer travels as well as for gas. Okay. That being said, that Xeroxes, yes, old school term, copies, cut and pastes for the modern tech.
Right. Yeah.
It copies that entire trade line, that long length of history, the perfect payment history, that low balance onto the kiddo.
Wow.
That's why my daughter had that 800 plus credit score at the minute she turned 18.
Wow.
It wouldn't have benefited anything to add her before 14. I also could have done it at 17 and 9 months and still given her the same benefit. Right. Why do I say do it in the 11th hour? Why do I say don't do it until the kid is ready? 3 reasons. Number 1, We want this to be an educational experience for our child to actually use the card, engage with the card, get comfortable, not creating debt. Second reason, how much life has happened to you in the past, let's just say 10 years. Have you had a card close in 10 years? Probably.
Yeah.
Whether it's because the store closed, the airline went out of business, you've probably had a card close.
Yeah.
Have you ever had to max out a card in the last 10 years?
Sure.
I know you haven't, but could you have had a late payment on a card in the last 10 years?
Right.
So doing it in the 11th hour, because it goes all the way back and it takes that entire line, cut and pastes it,
Right.
allows you to choose the strategically most advantageous card to add them to.
Right.
Instead of worrying every month, oh, geez, I'm sabotaging myself. Not just me, though. I'm sabotaging my kid.
I like to set it and forget it.
Yes.
And especially with as much fraud as going on
Yeah.
and the rise of AI and
Yeah.
all of the information that's going to be flooding children, and especially through socials as well, right? We don't know what information is going out there to our kids.
Well, but like those, here's another one for the modern generation. We see these fun top 10 lists. Yay! What would be your clown name? The street you lived on when you were 9, and your first pet's name would be your clown name.
Oh, yeah.
Okay, those are password question answers.
Right. Wow. Math. Oh, my gosh. That's sketchy.
How many people answer these things every single day on
Every
Facebook,
day,
Instagram, because they're having fun with
Boom.
their friends?
Gone.
They just gave every single password.
Oh, that's rough. So, number one, lock that down.
Yeah.
Lock that credit score. I get it in that situation. It makes sense.
And I say lock it, period.
Yeah.
Until you're ready to make a
Until you're
financial
ready.
decision.
Right.
30 days before, toggle it off. No big
Yeah.
deal. Cool.
Sure. Okay.
But have it frozen the majority of the time.
It's come a long way.
Yeah.
You know, it used to be like, oh, I can't get my credit on froze, Jacob. I'm not ready for you to run I go to run credit, can't run it. Unlock your credit. I'm trying to unlock it. Now it's just
I can't remember my PIN that I set up 28 years ago.
You know, so for me, from my perspective, the pain point is don't lock your credit. But then at the same time, when they're getting their information compromised, they're going through the police reports, they're losing their credit, right?
Yeah.
Because of that. I don't see all of that as the mortgage broker that just sees you when you come in. So I can definitely understand, like, from that perspective of the requirements, especially if you're targeted, and then the targeting is just going to continue for everybody as we proceed into the AI technology race. Yeah, the technological, however you want to say it, the AI boom, the data compromise, and the social giants that are just continuing to push that out there. So give me a teaser for the next podcast. So the next one, we should dive a little deeper into self-employed borrowers.
Yes. Because credit applies to everything.
Yes.
It's not just personal. It's also business. It's also all of the things. It's your opportunity to just create all of these different pathways.
Yes.
I think the most important thing that hopefully everyone walks away from this with is that we can pre-plan.
Yes.
We can avoid so many pain points in life if we have access to everything. We don't have to use it. We don't have to ever have debt, but if we have access to all of these things and the knowledge of how to keep that Botox in our credit score,
Yes.
then
Lock it down.
Yeah, we're always going to win.
And with the self-employed individual that's starting out, maybe they're doing a lease build out where they just lease and they're building out a location, but then eventually they want to own, maybe finance an SBA purchase on that business. What's the best thing that they could do now to position themselves to actually own their own business location, their own building one day?
Everything. So it always is going to start with personal. We can't build business without personal being on point.
Right.
I get people all the time that come to me and they're like, okay, I'm ready to do the business because my personal has tanked. So now I need this for my business. And I'm like, we've got to get your personal back on track first.
Right.
Then we can do that. So before we're ever ready, before we ever think about scaling, we're already too far steps back.
Correct. So go back to first base before we go to second base. We can't skip first base.
Well, and before that though, we have to go to the fundamentals. Let's get the actual tee for the T-ball, and let's find out how to hold the bat and what the rules are of the game, and then we can get on the field.
Right.
After we stretch and warm up
Yeah, I love that analogy, and we're constantly circling the wagons to try to help people look at the fundamentals and to not overlook the specific items that's going to affect them for the long term.
Yeah.
Thank you for coming on my podcast today. I really appreciate your time
Of
today.
course. Thank you
Thanks
for
so much.
having me. Really
Appreciate it.
appreciate being here. Again, I'm Alexandra Ehrlich. I can be reached on any of the socials that I have just now deprecated. And I am on Instagram as well as TikTok, Facebook, YouTube, and can be reached on my website. Everything is under Alexandra Ehrlich, AlexandraEhrlich.com, or first and last name on any of the social medias. I can be emailed or contacted by phone, 303-668-0300. Look forward to talking to you soon. Every consult is always at no cost initially, and we can figure out whether you need a plan, a strategy, or you just want someone to chat about and go from there.
Thank you so much,
Appreciate you.
Alexandra.
Thank you.
Appreciate it.